Welcome back to the boardroom of EU Incorporated. We have spent a lot of time talking about how to succeed, how to build your philosophy, and how to structure your trading business. Today, we need to having a difficult conversation. We need to visit the graveyard. You have heard the statistics. Depending on which study you read, 80% to 90% of retail investors lose money over the long term. They don't just fail to beat the market, they crash and burn. Their businesses go bankrupt. If we are going to treat our investing as a serious enterprise, we must study those who failed before us. We need to perform an autopsy on failed investment entrepreneurs to understand why they died financially. Success leaves clues, but failure leaves even bigger ones. Today, we will examine the common traits that lead to the destruction of capital. If you recognize any of these traits in yourself, consider this a wake-up call. The first, and perhaps most common trait of the failed investment entrepreneur, is the lack of a business plan. They are operating as a gambling operation, not an investment firm. Imagine someone asking you for money to start a restaurant. You ask to see their business plan, and they say, "I don't have one. I'm just going to buy some food, open the doors, and see what happens. I have a gut feeling it will work." You would never invest in that person. You would call them delusional. Yet, millions of people open brokerage accounts with thousands of dollars of their hard-earned savings without a single written rule. They buy stocks because they heard a rumor at a party. They buy because a chart looks good today. They have no criteria for what to buy, how much to buy, or, most importantly, when to sell. Without a plan, every decision is reactive. When the market drops, they panic because they have no procedure for drawdowns. When the market soars, they get greedy because they have no rules for taking profits. The failed entrepreneur treats the stock market like a casino. And as we know, in the long run, the house always wins against the gambler. The second common trait is emotional instability. The failed CEO allows their internal emotional state to dictate their external business actions. The stock market is a magnificent machine designed to transfer money from the emotional to the disciplined. It is highly efficient at triggering your deepest fears and your highest greed. The failed entrepreneur feels these emotions and acts on them immediately. They experience FOMO, the fear of missing out. They see a stock skyrocket, and even though it is wildly overpriced, their emotions scream, "Buy now before it's too late." So they buy at the top. Then, the inevitable correction happens. The stock drops 20%. Now, fear takes over. Their emotions scream, "Sell now before you lose everything." So they sell at the bottom. This cycle of buying high on greed and selling low on fear is the engine of bankruptcy. A successful CEO feels the same emotions, but they do not act on them. They refer to their business plan. The failed CEO uses their emotions as their investment advisor. The third trait is arrogance, often disguised as overconfidence. This usually happens after a period of easy success. Perhaps they entered the market during a strong bull run. They bought a few risky tech stocks, and they doubled in value. Suddenly, they believe they are geniuses. They mistake a rising tide for their own swimming ability. This arrogance leads to the deadliest mistake in investing: excessive leverage. They start borrowing money to invest, convinced that they cannot lose. They believe they are smarter than the market. They believe they have found a secret sauce that no one else knows. The market has a very painful way of humbling arrogant people. When you use leverage, you don't need to be wrong for very long to get wiped out completely. A small pullback in the market becomes a catastrophic event for their highly levered portfolio. The arrogant entrepreneur usually ends up losing not just their own money, but money they don't even have. The final trait we will discuss today is short-termism. The failed investment entrepreneur is obsessed with getting rich quickly. They are not trying to build an empire over 20 years, they are trying to pay for a luxury car by next month. This short-term focus forces them into high-risk, speculative behaviors. They ignore fundamentals and chase volatility. Building a real business takes time. It requires patience. It requires the ability to endure boring periods where nothing seems to happen. The failed entrepreneur cannot sit still. They feel the need to constantly do something. They overtrade, racking up transaction costs and taxes that eat away at any potential profits. They chop down the tree to get the fruit, instead of letting it grow and waiting for the harvest. If you find yourself seeking instant gratification in the market, you are on the path to failure. Wealth is compounded over time, not created in a single day. So, look in the mirror. Do you have a written plan? Are you reacting emotionally to prices? Are you using dangerous amounts of leverage because you think you can't lose? Are you trying to get rich by next Tuesday? If the answer is yes to any of these, your investment business is in danger. The good news is that these traits can be unlearned. You can choose to change your approach today. These failures often stem from a fundamental misunderstanding of what the market actually is. The failed entrepreneur views the market as an opponent that must be defeated, a beast that must be tamed, or a casino that must be outsmarted. But what if that perspective is wrong? What if the market isn't your enemy? In the next episode, we are going to shift our paradigm completely. We will explore a healthier, more profitable philosophy, seeing the market not as an adversary, but as your greatest business partner.